name is Matthew Manson. I'm the President and CEO and Director of Radisson Mining Resources. Radisson is the O'Brien Gold Project, a famous project in the history of gold mining in Quebec. The company is developing new resources and a new development path located right in the heart of the Abitibi, the home of gold mining in Quebec and Canada.
Matthew, how are you, sir?
I'm well, how are you?
This is just the beginning of a long week of sitting in front of investors and talking, but not a bad time to be doing it.
Oh, it's terrific. I mean, we're looking at the gold price this morning. Is today the day that it hits 4,000? It might be. Yeah, it's terrific. Full room, full dance cards with meetings in these 5 cities in every city. It's terrific.
Yeah, I think the advertised number is 150 people, and then and a room full of men at the lunch. At the lunch is a thing to behold.
Pretty healthy. Yeah.
Pretty healthy. We're here as part of this kind of Michael Gentili organised sort of roadshow. I mean, we're in London today. You're Paris tomorrow. Where are you heading off to after that?
Geneva, Zurich. We end up in Frankfurt.
Right. Okay. So if it's anything like today, that'll be a good week.
We've seen the registrations. It will be like this in every city. Yeah.
Right. Okay. So I guess the purpose of it is to get your story over in a sea of companies also trying to do the same thing, but you're slightly ahead of the game, aren't you?
Well, yeah, Mike, we're here as part of the portfolio of Michael Gentili, you know, a successful, prolific investor, somebody who's got a fantastic reputation. He's on our board. But what the people are seeing when they come to this event this week is a curated list of 6 companies that Michael has sort of is presenting. Yeah. You know, the best of the portfolio, and the portfolio is good. So there are 6 companies here. We're all a little bit different in terms of location, commodity, but we all share the same attributes that he articulates when he speaks at these events as what he's trying to achieve in his investment portfolio. So you're getting kind of a pre-approved list of quality names here with quality teams presenting good projects that Michael is involved in, and by involved, he's not just a passive investor. He's on our board. He's actively involved in many of these companies, and he puts his money where his mouth is as well.
Well, he is, and I think we'll actually share some of that information with folks as well separately. But he got in early. He talks about being a contrarian investor. He's got to believe in a thematic, and there's not too many of those. I think a lot of people talk a good game about being contrarian investing, but very few are brave enough to do it.
Right.
How has he been in the company?
Well, yeah, he's terrific. Look, he's lots of resource public companies will have a director or 2 or 3 who identify themselves as the capital markets expert. And Michael really is the capital markets expert. I mean, he is in the market, he's investing, he's lived a life on the buy side as a fund manager. He's now investing his own money. So he really is very knowledgeable and very on the mark as the capital markets voice in your team, because he's very much in the team. And he's also a terrific guy personally. I mean, as somebody, good public companies, good resource companies are happy ships. And you want the board aligned, you want the management team aligned, everybody working towards the same goal. You don't want drama. And Michael is a terrifically constructive voice, and he's a collaborative voice, and again he puts his money where his mouth is, because he is investing his family money, his personal money in you and the company and what you're trying to achieve. He's always available. I'll call him up. I speak to him very regularly. I'll call him up and he's always available. He might be on the school run with the kids, but you always get him. And I can't say enough about Michael Gentili actually.
Well, I think here's the interesting thing about this, and it's when I talk to retail investors, I say this is your money. You should care a lot about where you put it and why. And I think in this case, it's Michael. You talk about pre-vetted, etc. This is his money. He's not a fund manager
no, that's right.
other people's money.
He's not using other people's money.
and I know this because I was on that side, you're just a little bit more casual than you would be if it was your own money. So I hear what you're saying there.
Yeah, no, he's very aligned with everything.
Yeah,
right?
yeah. We better talk about the company, better talk
Yeah,
where
right.
you're at, right?
Yeah.
So maybe give us an update. And where have you been? What have you been doing since I last saw you?
Well, we've the project is really taking off. I mean, it's the old O'Brien mine, and by old I mean it was an operating project between the 20s and the 50s. Famous in Quebec mining history, Canadian mining history, for being the source of rock samples, really impressive visible gold samples that are in various collections around the world, including various museum collections. There's a big suite of samples in the Royal Ontario Museum in Toronto. So that's what the project was known for. Yeah. Super high grades that produced.
Like, what are we talking about here? What sort of grade?
Oh, well, the original mine was half an ounce head grade, but the samples I'm talking about are just like, heavy lumps of gold, right? That came out of so that's what it was known for. The company's been diligently growing new resources around the edges of the old mine on the trend. It's the Cadillac-Larder Lake Break, famous structure. Lots of mines have been centered on. So there's more gold on both sides. On the eastern side, there's a new resource there. It's about 1.5 million ounces, high grade currently, and it's growing. And I think the going thesis here was, well, this is now good enough to be a new mine. And for me personally, and for the board, and this is one of Michael Gentili's criteria, there has to be visibility to a mine there, right? And I'm not interested in running Radisson as an exploration company for the next 20 years. There has to be a mine. So there is already. And it's a good mine on the basis that the ore goes to somebody else's mill. There's lots of mills in this part of the world. They all have varying degrees of future capacity.
Right, okay. And so you can play that off against each other. Is that the idea?
To the best of our ability, but the dance card is pretty long here.
Okay.
So, because there's lots of mills. And if you're an owner of a mill, the trick is not to close it, right? They're expensive to build and permit, and tailings facilities are expensive to build and permit, and they're expensive to close.
Yeah.
So
and recommission.
And recommission. So, so the legacy in this part of the world has been mills and tailings facilities that maybe go for decades, and there are some here that are from the 70s and 80s, and you're filling the mill. So successive ore bodies are found and developed to fill that mill. Yeah. And so this is the hub and spoke model, but there's several examples of this hub and spoke complexes all the way along that Cadillac-Larder Lake Break trend through that part of Quebec. And we are sitting right in the middle of that world. And so the obvious thing here is that this ready to go, big enough to be a new mine resource, goes to one of these mills. And so the job is, when does that happen? On what terms does that happen? And what is the best value outcome for Radisson and the shareholders in doing that?
Right.
The surprise has been, as we've been diligently working in those directions, talking to people, de-risking the asset, doing our metallurgy, bringing out engineering studies, talking to mill owners. There was a process we talked about a lot last year, which was an MOU with IM Gold around the Doyen mill, part of the Doyen Westwood complex, where we did a milling assessment, and we then produced an engineering study that showed what that looks like if our project goes there. But as this work has been going on, the surprise has been the exploration and the drilling, because it's good enough to work right now, we believe. But we said, okay, well, let's get aggressive with the drilling. Let's do these big step outs. Yeah. And this is what's called a mesothermal gold deposit, orogenic gold, another expression for it. And the paradigm is that it keeps on going down. So there'll be no Nobel Prize in exploration won here, because it's been a pretty simple thesis. It probably keeps on going down. So let's drill deeper. Mm-hmm. And yeah, we hit. And we've hit everywhere we've drilled. Okay. So we've hit below the old mine, below the new resource, and it's obviously getting bigger.
And you think that's the best use of your money, to focus on the drilling component, as long as you can partner with one or other of these mills up the road. And is that the long term? Are you mine builders, therefore? Do you need to be mine builders if you can process using some? Because I think they obviously the initial kind of capex can sometimes kill businesses, or at least affect their returns. Yeah. So explain the kind of financial model of the business model.
Right. So we've estimated based upon a recent engineering study, that if we're not building a mill,
Yeah.
and then we're not building a tailings facility, and those are the two chunky and expensive and risky parts of a mine build.
Hundreds of millions.
Hundreds of millions, and that's where your trouble begins, in the spaghetti of the mill and the moving of the earth of the earthworks. That's where the risk is.
Yeah.
So if you're not doing that, you've got a low risk project and you've got a low capex, because in our case, where we are, right off the highway, there's a power line right there. We're right beside mining towns, so we don't need anything other than the mine itself, the underground mine, the money to develop that, and minimal surface facilities and a water treatment plant for mine water coming out of the mine. So we estimate that in this recent mining study to be 175 Canadian million. That's all.
Okay.
And you know, and the NPV of the project in this recent mining study at $2,500 gold, just using a subset of the existing resource, which is just 740,000 ounces, so just a small subset, we get like a $500 million NPV, which is 3 times the capital, which is a metric, which is a good measuring stick, right?
Right.
So,
talk to me about the drill, because you got mining towns with people living at home, traveling at home. So in terms of things like the drill cost and I guess the discovery cost of the new answers.
Yeah. So so getting back to the you know, on a dollars and cents valuation metric rationale, you asked what's the best use of our money right now, drilling. There's 2 ways to answer that. There's the tactical and strategic answer to that, but there's also just the dollars and cents. We're trading about $150 Canadian per ounce right now, a little bit more as of today. The stock's doing well. Our discovery cost in that part of the world is maybe $30, $40 an ounce. So if you're raising money to put in the ground to discover ounces at that rate, it is accretive every day of the week. So just on that, if you want to be a kind of a valuation guy, that is a good use of money, right? And we are adding ounces, and it's obviously getting bigger. The target is between 3 and 4 million ounces, compared to 1.5 now.
Grading, do we know?
Same grades, so 8 grams in the indicated grade, a little bit less in the inferred grade. And that's based upon the thesis that if what we see at the top continues down to a 2-kilometer floor, which is what our neighboring projects you know, touch, what do we get? Just ounces per vertical meter dropping down, and it's between 3 and 4 million ounces. And so the drilling we're doing is kind of big step outs to fill that gap and demonstrate whether or not that's a good thesis or a bad thesis.
Right.
And it turns out that it's there.
And what type of mining are the neighbours or the comps doing?
Mining in terms
Well,
of...
it seems like you're going, okay, you've got a 2-kilometer floor.
Yeah.
There. Are they high grading? Are they? How do you get after this?
Well, it's quite a different kettle of fish. I mean, I think the best analog for us is a specific project called Lapa that operated up until about 2018. It was a Nico Eagle project that was a satellite deposit, just the mine, trucked to their mill at La Ronde, about 30 kilometers on the highway. That was the same grade as us, same narrow quartz veins, high grades in what's called the Piché Formation. That was a blind deposit, it wasn't at surface, so it started at about 500 meters and went to about 1,500 meters. They put a shaft down, they mined it at like 2,000 tons a day, and they did about 120,000 ounces a year. And relatively short mine life, 8 years or so. But the mining method, the way it was mechanized, the production rate was a little bit more than we're currently contemplating. But grade, metallurgy, deposit style, identical to us. And so that was down quite deep, right? And it was an 8-year thing, but it was quite profitable. So we have an analog for our project which is almost exact in every way.
Okay.
Right? And that's a good and
is there a but?
No, there's no but.
No,
I mean,
okay.
the Abitibi in Quebec is rich in variety with metallurgy. So you get the big, low-grade open pit resources. You've got Malartic, second biggest gold mine in Canada. You've got the original Doyen mine, which was like that. You've got narrow, high-grade vein deposits. Westwood with Iron Gold is like that. Kena with West Dome is like that. You've got big, massive sulfide, VMS, polymetallic things. La Ronde is like that with Nico Eagle. So it's a bounteous, zone. Where we are up against this Cadillac-Larder Lake Break, There's a very well-established deposit model, which is the high-grade quartz sulfide veins. So, and Lapa is the one we always point to as, you know, the exact analog, recently developed on a similar terms as we would anticipate O'Brien getting.
So you've got an understanding potentially what the margins could be at the various stages of the development of this. And is there anything in you that says, well, at some point maybe once the cash flow or free cash flow is there, we do take control, we do buy one of these mills, which maybe perhaps isn't getting the feed that it requires, or do you think, no, actually, do you know what? I'm very happy with this kind of competitive environment for the processing of our ore.
I think so. Let's think in value terms. There's no scenario where, on a project level, it doesn't make sense for our ore to go to an existing mill with an existing tailings facility, avoid all of that risk and capital, and that is in every universe, that's the best way of delivering value.
But the moving variable here being gold price.
Well, I mean, when the project, I'm saying when, I should say if, you know, forward-looking statements fully apply to everything I'm saying, but if we get to 3 to 4 million ounces in a resource, and the project will happily support its own mill and its own tailings facility, and it will happily support Radisson doing that and building that mine. It'll still always be a better value outcome if you're not building the mill or not building the tailings, however big it is. But it does become a healthy standalone project on that scenario. And it's important for us to get to that stage, whether that's what happens or not, because that ultimately gives us the best optionality for our company in delivering value, whatever that value is going to be, right? And so O'Brien and Radisson are on that path. And there's 9 mines have been built by the directors of this company, and we have 9 of them. Some people go through a mining career and never do that once. It's quite rare. So I've got 3 I got 2.5.
Most people don't make a discovery.
Most people don't make a discovery, and you know, you can be a school leaver and get a nice job in, I don't know, Newmont and go up through the ranks and never actually experience building a mine. So we have 9.
What are the 3 that you built?
Well, I was a lieutenant. I was the second in command at Aber, which was the joint venture partner with Rio Tinto when the Diavik diamond mine was built in the Northwest Territories. So that was 2002, 2003 time. So then I was CEO of Stornoway Diamonds when we built the Renard mine, which was another diamond project. That was the last big mine built in Quebec. That was mine. Built on budget and on schedule. Every metric worked apart from the diamond price. And so I describe myself as a bit of a refugee from the diamond business because it's been
it's tougher now.
It's been a slow descent down in diamond prices, and it's an industry which has basically been killed by synthetics. But that was a great experience, and that mine was built well and operated for 8 years, just recently closed. And then I got halfway through the building of the Valentine Gold Mine in Newfoundland. I was the CEO of Marathon Gold. And and then we got about halfway through the build. We needed to raise more money, and we could have done that. And bids started coming in, and we made, in hindsight, the absolute right decision, which was to take one of the bids rather than keep financing. And that was Calibre acquiring Marathon, which is now Equinox, and that's been a good run. So I think Marathon shareholders did very well out of that. And that's how I actually met Michael Gentili, because he was an investor there. So I count that as half of a mine. Valentine just poured gold last month, first gold bar. So that'll be a terrific long life project. So I've been through the process of taking a greenfield project through engineering studies, permitting, resource definition, social acceptability, project financing, construction operation. I've done it 2.5 times, once as a lieutenant, twice as the CEO. And so for that reason, this board is fully capable of doing it again. But
should you choose?
Should we choose?
Yeah.
But there are no itches left to scratch in that particular way.
Right.
Nobody has to do it again.
Yeah.
And what is the dollars and cents value?
We're talking about
considerations here?
return on invested
Yes.
capital. That's
Right.
what we're looking at.
Yes.
And that's the smartest way to build a business, the smartest way to invest as well. That's what you would look to if you're investing.
Yeah, yeah. If you look at, just put your value hat on in this situation, the best value in the project is always going to be going through an existing mill, an existing tailings facility.
Yep.
And how does that then translate into the best value for the owners of Radisson Mining Resources, which are the shareholders, right? And so if the project becomes fat enough and high margin enough
Yeah.
to support its own standalone development, which I think it will,
Yeah.
that is a useful optionality
Yeah.
to have when you are considering what the final outcome is going to be. And so I think that's how I see it, right? And so we're not charging down we're going to build it kind of path necessarily, but we are charging down the drilling path because it's a great use of our dollars right now and it's getting bigger.
Well, ultimately, that's what it comes down to is, what's the best use of those dollars? What's the best return on those dollars invested? You've got a train to catch there.
Yeah.
I'm going to shake your hand and
off
let
to
you
Paris.
go and do that and do this all over again.
Terrific.
Better that than sitting in an empty room, isn't it?
I'm not complaining.
No.
You know.
No. Make hay while the sun is shining.
Yeah. Thanks very much.
Matt, appreciate your time today. Thank you.
Thank you.
Cheers.